Good morning, ladies and gentlemen. Welcome to IGE Forum this morning. And good morning to Dr. 슈바라만. Thank you very much for joining us live from Singapore. Today, I'm so very pleased to have distinguished guest speaker, Dr. Robert Subbaraman, who is a highly respected expert on Asian economy. I'm confident that his thoughtful views will help us better understand the nature of global economic prospects this year, along with its implications for financial policies and investment strategies. During his presentation and discussion today, special attention will be paid to the challenges facing Asian economies, especially China and Korea, which are, of course, of great interest to us. Very briefly about Dr. 슈바라만. Currently, he is the chief economist and head of global market research for Asia, ex-Japan, and at Nomura, a global leading investment group. He chairs the Asia Research Executive Committee and is also on Nomura executive committees for global market research and global emerging markets. Prior to his joining Nomura in 2008, he was at Lehman Brothers for 12 years and was chief economist for Asia. He also held senior positions at the Reserve Bank of Australia before. Without further ado, let's welcome Rob, who will speak for about 40 minutes, as I understand. He has lots of interesting things to talk about this morning, followed by our Q&A session until around 11 or a little after 11 a.m. as scheduled. Rob, floor is yours.
Okay, thank you very much, Jun. And it's great to be back at the Institute of Global Economics, even if it is virtual. It's a pleasure to be back. I did this about 1 year ago, and my times have changed in the space of 1 year, which I plan to go through. So without further ado, let me just get up my slides. Just bear with me a second. Can you see my slides okay?
Not yet.
You can see them?
No, I can't.
Oh, okay. Hold on a second. How about now?
Yes, we are seeing.
Okay, great.
Yeah.
Okay, let's get started. I've entitled the presentation 2023 will be Asia's time to shine. And so a little bit of a hint that we do think at Nomura that overall this year is going to be a positive year for Asia. We think Asia will lead the global recovery. But before I get into that, let me start with telling you what we've got wrong so far. We published our 2023 Outlook report roughly 1 month ago, around the middle of December. And a lot has changed in that past month. I must say, when I was and my team were writing our Outlook report a month ago, it was, in our view, extremely uncertain. we felt that and we did write in the introduction that we had to have a lot more humility as economists in forecasting than we typically do. And I've been on record to say in my 30 odd years of doing outlook reports, doing this one was probably one of the most challenging. And I think it's partly because the world economy right now is in disequilibrium, and we're not sure exactly where it's going to end up landing. And if you look at what's changed over the past month, 4 things I would say have changed. One is we're getting more conviction that US inflation is easing, including underlying, and that makes us feel the Fed is getting close to stopping raising rates. So we previously, a month ago, we thought the peak Fed funds rate would be around 5.75. We now think the upper limit will be 5%. China, the reopening of the economy, I think how fast it has been has caught us and I think many others by surprise. We thought full reopening would not happen until March at the earliest. More resilient economies in Europe, I think, is starting to play out. And of course, on 20 December, the BOJ caught people by surprise. And there's a possibility the same thing could happen again today. So in a nutshell, we still see mild recessions in the US and Europe, roughly about 0.5% decline in GDP growth. I would stress, though, that these are fairly mild. I would characterize our forecast as a fairly soft landing for these economies, given how much and how fast interest rates have been raised. You can see on tight monetary policy to lower inflation. Essentially, our view is that the central banks will be successful in slaying or bringing down inflation. We think the Fed will hike by 50 basis points more, 225s, but the ECB, we think, has a lot more rate hikes to do compared to the Fed. China recovery, we do think it's finally on the cards with the reopening. We're forecasting 4.8% growth this year with upside risks. And as I'll talk more about, we think Asia is going to lead the next global recovery, starting in the second half of this year. But I'd say the risk is rising that it could start possibly a bit earlier, like Q2. This slide just gives you a bit more detail on our forecasts. We expect mild recessions in the West and a notable recovery in China. We expect central banks to ultimately be successful in bringing down inflation. The thing about, if you look at the first, the top column, the top rows on GDP growth, you can see that the quarter-on-quarter contractions, they last for quite a while, but they're fairly mild. So I'd say, in our view, it's a fairly long-lasting recession, but it's not a deep one. And that's because we don't have monetary and fiscal policies quickly coming to the rescue in easing policy as much as we saw during the pandemic or during the global financial crisis. So milder but more drawn out is the way I would characterize it. Okay. Moving on to a little bit more detail on the US economy. So I'd say the biggest thing that has changed in the US economy in the past month or so has been growing signs that underlying inflationary pressures are abating. If you look at the left-hand chart, this shows you various measures of kind of underlying inflation. And 3 of the 4 measures have started to decline. The exception is really house prices or owner's equivalent rent prices. But we know that that lags. And if we look at private rental measures in the US, they have started to abate. I think probably the thing that makes us most encouraged, and we believe the Fed also, is wage growth is starting to ease, because the big concern, I think, is that while goods price inflation is coming off as supply bottlenecks ease, the concern was that services price inflation could be more sticky. And an important driver of services prices is really wage growth. And if you look at this right-hand side chart, average hourly earnings, which is reported during the US payrolls, non-farm payrolls, has rolled over. But what we think is more important is the Atlanta Fed's wage growth tracker. It's a much more comprehensive measure of wages. It does not get distorted by compositional shifts. It has started to also roll over, particularly the less reported unsmoothed measure fell quite sharply from 6.5 to 5.5 between November, December. So that's suggesting the official kind of 3-month smoothed measure will probably continue to slow down in the coming months. So all this supports our view that inflation in the US, our core view is it will continue to moderate to 2% by the end of the year. I'm not going to go into too much detail on the details of the forecast for the US. I think I've talked about a mild recession, minus 0.5% growth this year. We do think unemployment will start rising. It typically lags the economy, and that is a necessary requirement for wage growth to decelerate. And as I mentioned, we do have core inflation easing. We have the Fed hiking by 25 basis points in February and March, and then pausing all the way through to September before it starts cutting rates. Turning to Europe, I'd say the most interesting thing around Europe is and I'd say the economic consensus is becoming less gloomy on Europe. If you go back 6 months with the Russia-Ukraine war, there was a very big concern that Europe will not have enough gas to get through the winter. But it's been a warmer winter than expected. Europe has done very well in building stockpiles of gas, and gas prices as a result have come down very sharply. But also there has been a lot of fiscal stimulus across the European economies, which has helped buttress the economy. And you can see from these 2 charts, the survey of surveys is basically a composite of all the business surveys for the Eurozone, and it has started to turn up. But more importantly, the right-hand chart, Germany, the biggest European economy, industrial production, the hard data hasn't really turned down that much. And we think that has a lot to do with fiscal stimulus. If I look at this table is interesting. It's showing you the changes in policy interest rates since central banks really started hiking rates. And you can see Korea was one of the first to hike rates out of these countries. I wanted to make a few points about this table. The first one is that going forward, we expect the ECB to be more aggressive than the Fed. So as I mentioned, we have the Fed hiking by 25 basis points in February and March. But for the ECB, we have 50 basis point hikes in February and March, and then 2 more 25 basis point hikes. So going forward, we have the Fed hiking by a further 50, but the ECB hiking by 150, so 3 times more. A few reasons for this. One is that, unlike the US, we're not seeing strong evidence yet that underlying inflation in the Eurozone is easing. Wage growth still seems to be fairly strong. Core inflation, the month-on-month measures also are fairly strong. Secondly, a very simple point, but if you look at the ECB policy rate right now, it's only 2% compared to 4.5% for the Fed. So in our view, the ECB has still fairly loose monetary policy and still has some work to do to get it into a more restrictive stance. And the third point is really to do with the chart I just showed you previously, that on the growth side, Europe is looking a bit more resilient, and that should provide more room for the ECB to raise rates. I would also point out, and I will discuss this more later, but if you look going forward, we do have the Bank of Korea being one of the first among the major central banks to start cutting rates in May. Okay, just turning to Asia, I did say that Asia 2023 will be the year that Asia starts to shine, but in the coming months, we do remain a little bit cautious, and that is because we think Asian exports, the downturn is going to continue to deepen. We have several leading indicators of Asian exports, and they are suggesting right up to February, Asian exports will keep decelerating. Our sense is that the bottom in Asian exports could start to happen in the second quarter of this year and an upturn in the second half of the year. But as you can see on these charts, Asian exports could fall further, and there also seems to be an unintended inventory build in Asia, which could weigh on production. So the export downturn is because of the recessions in the West, the global tech downturn, but hopefully it'll take some time. We do think China will help stabilize Asian exports once the reopening gains more traction. And on Asian exports, I would just point out this chart here shows you how much of Asian goods exports go to China versus US and Europe. If you're on that 45-degree line like Korea is, it's roughly half-half. But most countries still export a bit more to the West than to China. I would also point out that not all exports, Asian exports that go to China stay in China. Some are processing exports that get assembled and then re-exported out where final demand is the West. Okay, let me spend a little bit of time on China. I think it's very important for Asia and also, of course, Korea. The first point I would make is around China's exit from zero COVID strategy. it was always going to be very challenging. And the basic reason is shown in these two charts. And the striking thing, this data is early December, when China was having the street protests over zero COVID strategy. And it was just before China started to change its policy. But you can barely see confirmed infections, cumulative confirmed infections for China relative to other countries. And that is essentially because China was so successful in keeping down COVID-19. But in a way, China has been a victim of its own success, because it has meant very low herd immunity when it comes to the exit from zero COVID strategy. So right now, we are seeing a surge, a very big surge in COVID infections in China and fatalities. Why did China do this U-turn, shifting from health concerns and avoiding COVID-19 to now, I think, more of a policy of living with COVID-19 like the rest of the world? Well, I think, part of the reason was that the zero COVID strategy was becoming less and less sustainable, because Omicron variant was so transmissible. It was becoming harder and harder to avoid infections without really freezing up the economy with lockdowns. And you can see, I think, the left-hand chart on China consumer confidence is a good summary of what had happened. The ongoing rolling lockdowns, I think, eventually had taken their toll, and you can just see consumer confidence really plummeted late last year. And it wasn't just for 1 month, it stayed at these historically very low levels. And then I think that brewed into social discontent. And ultimately, I think these two things, the question marks over the sustainability of the zero COVID strategy and the impact it was having on the economy, led to this change. Where are we now? Well, I would say, we are seeing, like other countries, a health crisis in China in terms of hospitals under a lot of pressure, fatalities increasing very rapidly, as you see in the news. But the other point I would make, and this is where the markets, I think, are looking, is on the other side of this deep valley is greener pastures, where the economy will ultimately rebound. And if we look at in the biggest cities, we are seeing already people mobility is starting to increase in China. There is still the risk with Chinese New Year holidays about to start, and people in the cities, especially young people, moving back into the rural areas. We could see another wave of infections, and the danger is it could be more deadly, because a lot of the elder population live in the countryside. But I think for the economy, it is very likely that it is going to rebound as China starts to live with COVID. And I think that's what markets are very focused on. The big question, I think, is how much will the economy rebound? And this, I think, is a very interesting debate that economists are having now about China. I don't think we can have strong conviction one way or the other, but there is one view that the rebound in China will not be that strong. And it's because China does not have that much excess savings that will be spent. Unlike the US and Europe, there was not much government cash handouts during the pandemic. China's social welfare system is not that strong. And there has been a lot of wealth destruction from falling house prices, the main source of household wealth. And so, less excess savings for households, and maybe they will be wanting to be precautionary and keep some of more of those savings than in the West, given the loss of wealth and the weak welfare system. On the other hand, there is an argument that China's economy has been locked down for longer than other economies. People have been cooped up in their homes for so long that there has been some accumulation of savings, just even without handouts. People just haven't been able to spend their income. And so that is a positive. And on top of that, China is right now unleashing more and more monetary and fiscal stimulus. And that should gain traction only when the economy reopens and people are actually starting to spend their savings. So they're the two sides of the argument. I guess I'm leaning more on the side that there will be some pent-up demand, but I don't think it's going to be nearly as strong as in the US. Maybe as a rough estimate, it could be around half as strong in China as compared to the US. And the other point I would make on China, and this is a bit more medium term, is will China go back to full throttle stimulus, credit stimulus, and a debt-fueled investment boom? I'm skeptical. I don't think China will. I think the authorities realize that old growth model has reached diminishing returns. And with very high debt levels now, I don't think they will want to have a multi-year period of excessive policy stimulus. So I think the risk for the markets, not now, but maybe later this year, is some disappointment that Beijing doesn't keep the stimulus going for as long as the markets hope. Japan. So Japan's getting interesting. Inflation is rising. Inflation expectations have gone up significantly as well. And that's led to a lot of speculation that the BOJ is going to move away from ultra loose monetary policies. And it did widen its yield curve control last month. The interesting thing for Japan is whether wage growth really starts to pick up, because if it doesn't, it's quite possible that the rise in inflation turns out to be temporary. And with the yen appreciating, commodity prices coming back down, we could see inflation fall back off. But if you look at these charts, the thing that strikes me is that the labor market is actually quite tight now. It's not just unemployment, which is quite low at around 2.5%, but also labor force participation, particularly the prime age workers. The top right chart has increased sharply. And this is because female workers have really started to participate in the labor force. And we're seeing a more and more increase in full-time jobs now than just part-time. And I think the implication is that the unemployment rate at 2.5% now is suggesting a much tighter labor market than the last time it was at this level, because labor force participation is a lot higher. So my point, I guess, is that if there was any time in the last few decades where conditions are ripe for a wage growth pickup, I think it's now, given inflation expectations are higher, given the labor market is quite tight, given the government is pushing companies to deliver wages that match inflation with this spring round Shunto wage negotiation about to start. So where does that leave us? There is a BOJ meeting today. It's possible that there will be a further relaxation of the YCC policy. I think even if there's not, the BOJ is likely to revise up its inflation forecasts. And I think that with a new governor to be elected very soon, I think market expectations for a change in the unconventional monetary policies is going to continue to build. The Nomura view is kind of on the fence in the sense that our base case is inflation is going to decelerate, which suggests that the BOJ shouldn't really move away from its very loose monetary policies. But we're only putting a 50% chance on that. The other 50% is that the BOJ is going to move away from these negative interest rates and yield curve control, partly because we could be wrong. Wage growth could accelerate for the reasons I talked about. But also, there are signs that the BOJ is getting more concerned about the negative side effects of these very loose monetary policies, particularly around the dysfunctioning of the bond market and the loss of profitability for the banking sector, which can lead to ultimately unintended consequence of higher lending rates. So there is a real risk that the BOJ is going to start to follow the rest of the world in normalizing monetary policy. And if that happens, it could be a shock, not just for Japan, but the world. We could see significant yen appreciation. And we could see some financial stress. BOJ's had QQE longer than any other central bank. It's the old Warren Buffett slogan, we'll see who's naked when the tide goes out. For so long, Japanese have been used to very low rates. There could be some impact for large JGB holders. And also as Japan starts to, its institutional investors start to maybe reallocate some of their investments back towards Japan. Okay, Korea. As mentioned by Chairman Dr. Jun, Nomura has a more cautious outlook on Korea's economy this year than the consensus of economists. We are forecasting GDP to fall by 0.6% this year. So like the US and Europe, we are expecting a mild recession in Korea. And I would point out, it's not just Korea, US and Europe. There's other countries that we think are in a kind of similar situation to Korea in terms of household debt and housing markets, which we also expect recessions, including Australia and Canada. So let me go through a few of the reasons. The first one is exports are very weak now, and we think they will probably weaken a bit further. So we think that is going to be a major drag on growth. But in addition to that, when we look at shipments relative to inventories, partly because exports have turned down, but also consumption is looking like it's starting to weaken, we are seeing quite a notable buildup of inventories. And the inventory shipment gap is, on our estimates, very large now relative to history. And that suggests that there's less need to step up production, but rather companies will run down their inventories. So that's not good for the economy in the coming months. The other point I would make, and this I think is where we feel quite strongly, is that Korea has had in recent years a significant run up in house prices and also very strong credit growth. Economists often regard this as call it a major financial upcycle, a debt-fueled housing boom, if you like. With the economy slowing and interest rates going up, we're starting to see that unwind. And we think that this could continue for some more time. And when we look at other countries and history, the historical experience, when you have an oversized financial cycle that starts to unwind, it's more serious if it's where house prices have gone up that's been fueled by household debt. Because if those two things start to unravel at the same time, house prices going down and households deleveraging, there's a greater risk of what we would call a balance sheet recession. So that is our concern for Korea, that this financial down cycle now could be quite negative for the economy. I would also point out that in Korea, when we look at it compared to other countries, its private debt is relatively high. You can see Korea in the red column, but also the credit gap. So this is the deviation of credit relative to its trend, is quite positive compared to other countries where it's turned negative. So it's suggesting a positive credit gap, suggesting that more recently credit growth has been, in recent years, credit growth has been quite strong relative to its trend. So this, is a concern that this unwinding of the financial cycle, we think could cause some more financial stress, or keep the financial stress for a bit longer, contributing to the slowdown in the economy. So when it comes to Korea, we do think inflation will start to turn down as growth slows. As you can see in the second column, it's not a severe recession, but it's lasting 3 quarters. So GDP quarter on quarter, minus 0.7, minus 0.3, minus 0.7. But for the year, that gives you minus 0.6, which is, I think, relatively low compared to consensus. And that's why we have the Bank of Korea doing its first rate cut in May, and then continuing to cut quite aggressively this year. So that is our call on Korea. Just quickly, India, the momentum in the economy is starting to slow down when we look at a whole lot of indicators. So green is showing momentum, whereas as you get towards yellow and orange, it's slowing down. The reason we would say is a few things, but basically our view on India is there will be disappointment this year. We think growth is going to be around 4.5%, and that is below consensus. The reason is that India is quite closely linked to the global economic cycle, more than most people think. It's not just exports, but investment in India is closely linked to exports. So we're quite confident export growth is going to be weak in the coming quarters, and we think that will drag down investment growth. And in addition to that, interest rates have been raised quite a bit. So tighter financial conditions are a drag. And the benefits from reopening are pretty much over now as well. That said, when we look a bit further out for for India, and this could start to happen later this year in the second half, we think India is going to do very well when we're looking more medium term. So 2024, 25, 26, we think India is going to start to really shine. We have 6.7% growth for India in 2024. And that is because a number of reasons, but essentially India's balance sheets have been really cleaned up. And so once growth bottoms, there'll be a lot of room for investment. India also is a very young economy, demographic wise. It's experiencing rapid digitalization right now. And we think it will benefit from diversification as multinationals focus on a China +1 strategy. So we do feel that India is going to do very well in the medium term and attract strong capital inflows. And then I wanted to just stress for Asia, this is a heat map showing you economic fundamentals, various measures across emerging markets. And if you look at the far right column, it summarizes all the data in terms of aggregate Z scores. The higher the score, the more vulnerable you are. And it's color coded. So the greener you are, the stronger the fundamentals for the categories. And I would stress that Asia is, in our view, the economies are fundamentally stronger than LATAM or emerging Europe right now. And I would also stress that within Asia, we think in terms of the medium-term prospects, it's really India and ASEAN that are going to be the world's fastest growing economies, and that they will attract very strong capital inflows. And that can lead to something like a virtuous spiral where that leads to even further strengthening of growth. A lot of what I said about India applies also to countries like Indonesia, Philippines, Malaysia. These economies, young populations, rapid digitalization, the China +1 strategy of multinationals are all going to kick in our view. And as I said, the fundamentals are relatively good relative to EM overall. So that is kind of where we are a medium-term bullish. I'd say Asia generally, but in particular ASEAN plus India. They used to be known as the Asia Cubs. We think they're going to mature to be full-grown roaring tigers in the coming years and be very attractive to foreign investors. Okay, I just wanted to conclude with one final thing. We've done some work looking at lessons from history on the risk of hard economic landings from monetary policy tightening. And what we did was we searched for common features at the start, during, and after monetary policy tightening cycles. And that resulted in hard or soft landings. So we did this analysis for 101 past monetary policy tightening cycles over 1985 up until this year. And it shows that there were 41 monetary policy tightening cycles that ended in hard landings and 60 that ended in soft landings. And we find that if you look at this table, we find that monetary tightening cycles that end in hard landings do have some different characteristics from those that end in soft landings. For example, we find hard landings are more common if inflation is higher at the start of the tightening cycle. We also find that high household debt and property prices at the start of tightening cycles are common features of hard landings. And for EM, we find that large current account deficits at the start of tightening cycles also more often lead to hard landings. So what we did was we thought, let's apply all that to the current tightening cycle. So we looked at all these conditions at the start of the tightening cycle, and also what's happened during the tightening cycle, because we also found that it's intuitive, but the larger the interest rate increase during the tightening cycle, the greater the risk of a hard landing. And also the longer the duration of the tightening cycle, the greater the risk of a hard landing. So we basically did all this, and it's a scorecard, and we standardized the various measures. And if you look at the far right, it shows you the results. This should be regarded as a relative result, but it's showing that out of the advanced economies, the ones at risk of hard landing look to be the US, Canada, New Zealand. And then among the emerging markets, you can see Chile, Hungary, Colombia, South Korea, and other four that kind of stand out. And I would stress it's interesting that this result, a little bit similar to the result earlier, countries where there has been fairly high household debt and house prices do show up as being a bit more vulnerable. So Canada, New Zealand, Korea as examples of that. But down the bottom, again, similar to the result I talked about earlier, India, ASEAN being the new rising stars in Asia, you can see that this analysis suggests that they are going to have relatively soft landings relative to others. Let me stop there and pass it back to our host to see if there's any questions. Thanks very much for your time.
Okay. Thank you, Rob, for your brilliant, very comprehensive opening presentation. Appreciate that very much. We would like to have some open discussion, first with the couple of invited discussants. First, I would like to invite His Excellency Ambassador He Kyung-wook, Mr. He, who served as first Vice Minister of Economy and Finance in Korea, as well as Korea's ambassador to OECD. He also spent his earlier career at World Bank and IMF as a senior economist. Ambassador, you're on.
For Dr. Subbaraman, for your very comprehensive, informative presentation that gave us a lot of food for thought. But basically, in a nutshell, I think what you're saying is that for the global economy, you are much more upbeat than before, while for the Korean economic prospects, you are more pessimistic, as you mentioned, and compared to the ongoing consensus by the market. So I have two comments and questions. First is about the global economy. And as you know very well, basically global economy seems to be driven by the Fed. And all your assumptions seem to be based on the forecast that inflation in the US will go down much steeper so that the Fed will be moderate and start to actually go down in the second half. My question is that, what if those forecasts does not turn out to be true, so that the Fed has a risk of overkilling the economy? Because I have a couple of points. The Fed has been saying many times that they will fight inflation at all costs. They would not be on the second other bonds. And when you look at the economy, monetary and fiscal, usually when you do the tightening, monetary and fiscal should work together. But right now in the US, we have IRA, we have CHIPS Act, so that all this new industrial policy requires actually giving out money to the economy on the fiscal side, so that the monetary should do all the heavy lifting. And now there's a view that this 2% target would be really make sense in the current economy. And they seem to be blindly committed to 2%. All those things combined, if inflation and wage growth does not come down as steeply as you expected, there is a risk of overkilling by the Fed. That's about the global economy. My second question, which is much more relevant to many audiences over here, is about the current economy. As you pointed out, China, we're going to start to open up and grow like almost 5% this year. And Asia is the place to shine, as you mentioned. And, you know, Korea's exports to China is 30%, including Hong Kong. And Asia is basically the second largest export market. And when you look at the Korean economy in the past, whenever the global economy is recovering or booming, Korean economy also exaggerates that boom or the recovery because basically it's an export-oriented economy. And I agree with all the weak points of the Korean economy, but I just want to mention that all those frailties are well recognized by the government, and they're addressing that. And not only that, they now vowed to head-on address the structural issues like labor or education or wage pensions. And we have industrial strength in terms of the new emerging sectors like semiconductor, battery, SMR, electric vehicles. So when you look at all those things and the past resilience of the Korean economy during the Asian crisis, we just shoot up in the next year by 5.7%. Even during the 2008 crisis, we are able to eke out a 0.2% growth rate. So with all the, I agree with all the weak points of the Korean economy, but maybe we are underestimating the resilience of the Korean economy. So with all due respect, basically, I hope that you turn out right in terms of your global economic prospects, but I hope you turn out to be wrong for the prospects of the Korean economy. Thank you.
Legitimate questions for Rob.
Thanks.
Would you like to respond? Yeah.
Yeah, thanks very much, Professor He. Both very excellent questions. Look, let me start by saying that I want to be very humble with any forecasts we make right now. The world is extremely uncertain. I'm sure, as I showed in my first slide, we've already made a lot of mistakes 1 month into our forecast. So it's very difficult, very challenging to forecast. On your first point on the Fed overkilling the economy, I think you are spot on. I would say one of the biggest concerns I have around our base case forecast is that inflation does not come down as quick as we think. And there's two ways this could happen. One is, it seems markets, I sit on the trading floor at Nomura and I talk to our traders all the time. Markets are becoming more and more forward-looking than they used to be. And it seems like the risk is that with inflation coming down now, but it's still at a high level, markets are getting very excited that the Fed is going to start to pause and then cut rates. And the risk is that market rallying is going to ease financial conditions so much that it's undoing the Fed tightening. And so that will lead to stronger demand. And at the same time, maybe the structural inflationary forces like deglobalization, like aging populations, like all the efforts to slow down global warming are going to turn out to be more inflationary as well. So to me, the risk is that maybe in the second half of the year, inflation gets kind of stuck at around 4% or so. And the Fed, with strong memories of the 1970s, decides not to cut rates, maybe even raises rates. And that would be a big shock to markets. So I agree with you with that risk. On Korea, it is a little bit odd that I talk with our base case that there's going to be a more positive global outlook especially in the second half of the year with China recovering. But we have negative growth for Korea this year. What I would stress is two things. One is Korea, in our view now, has a big domestic challenge, and that is the unwinding of the housing market and household debt. Those two things combined historically are not easy to unwind in a economy-friendly way. And those two things, this is domestic, right? This is not the household debt, household prices, house prices, it's domestic. While Korea, is a big exporter, domestic consumption, domestic investment matter more for the economy than exports. So that's one. The second thing I would say is if you look closely at our forecast, the minus 0.6% growth for this year, most of that negative growth happens in the first half of the year. Actually, it starts this fourth quarter of this year, of 2022 is negative, and Q1 and Q2. So it's the first half really, which is negative, and then the economy recovers with global growth. But because it's the first half of the year, mathematically, it has a bigger effect on the overall calendar year growth forecast. So we do have some positivity in the second half, a recovery because of global growth, but it's not enough to avoid negative growth for the full year. Yeah, I hope that makes some sense.
Okay, thank you. Of course, forecasting makes us humble. It's always tough to foretell what's going to happen down the road. It's a very dangerous business as well. But just for the sake of sort of track record, if you like, I checked what you have done last year. Actually, about 1 year ago, we had a pleasure having you, Rob, as the first speaker of the year to talk about economic prospects. At that time, it showed that you predicted 1.9% growth for Korea, which is pretty close to actual figures, slightly above 2%. So, you have certainly established for many years reputation as being a very reliable source of views about the economy. But past success is no guarantee for future success, and especially I'm hoping.
I think sometimes you get lucky.
I am hoping that your forecast turned out to be not so accurate for Korea this time around. But that would be the wish from most of Koreans watching this video. Okay, thank you very much, Dr. Parr. Is that anything to follow up? I have one more discussant lined up. Are you done? Mr. Ho? Okay, that's fine. Okay, then I would like to now have Dr. Jang-young Lee, former Senior Deputy Governor of Financial Supervisory Service, and currently a Senior Advisor at Kim Chang. In the past, Dr. Lee served as economist at IMF and also President of Korea Banking Institute. Dr. Lee, you're on.
Thank you, Dr. John. My name is Jang-young Lee, a senior advisor to Kim Chang, but I'm an economist by training and practice. Dr. Subbaraman, let me first pay a compliment on your clear analysis of the state of global economy and also your bold views on the outlook for this year, as it is full of uncertain factors and thus very difficult to anticipate. My question today is a more fundamental one. I'd like to ask your views on the reason behind the large dichotomy we can observe between pessimistic outlook and optimistic, relatively optimistic outlook announced by many renowned institution. Among Wall Street banks, the Morgan Stanley, for example, seems to believe in rather optimistic scenario where US economy should experience a soft landing with the cooling inflation, which is likely to prompt the Fed to curb interest rate hiking. And interestingly, Asian emerging market economy could offer green shoots of growth as interest rate stop rising and US dollar even weakens. In contrast, the Goldman Sachs seems to have a pessimistic view of hard landing coupled with persistently high inflation and continued rise in federal fund rates. And about Asia, Goldman Sachs has very serious doubt over an economic recovery because of many risk factors, including high debt service burden, poor property market situation, and unclear geopolitics. Why is this scale of dichotomy so big between the two camps? I mean, even today, this morning, the dichotomy was observable between World Bank and the IMF. World Bank issued very pessimistic forecast of the global economy last week, and IMF this morning signaled upgrading of its forecast of global growth. So is it because the difference in economic models that explains the interplay between inflation and central bank intervention, or data collection problem, or is today's business cycle or financial cycle swing are fundamentally different from the previous Asian crisis of '97 or global financial crisis of 2008? Thank you.
Okay, thank you, Dr. Lee. Rob, the question on the dichotomy between different agencies, institutions, saying quite different figures.
Yeah. Dr. Lee, you probably don't remember, but I remember very clearly meeting you many years ago. So it's
Okay.
It's a fantastic question that you pose, this dichotomy between optimistic and pessimistic forecasts. Let me say a few things. So I think the root of the dichotomy really is to do with the heightened uncertainty around the outlook. If you think back, we had several decades of very low inflation. And it was really an economy that was, the global economy was driven, the business cycle was driven by demand. And then we had the pandemic, followed by the Russia-Ukraine war. These two very big shocks in quick succession, and shocks that we don't usually experience, once in a generation or so shocks. So I think it's knocked the world economy out of equilibrium. And we're not sure where it will eventually settle. Where is the new paradigm? I think is a very open question for economists. I think one thing that's very challenging now is maybe the economy is not just driven by demand anymore, just demand, but also supply. It maybe is a more supply constrained economy because of geopolitics, because of climate change. Maybe these things are leading to supply disruptions as well. So part of the reason, so that's the kind of the backdrop. I think we're in a disequilibrium, and that makes it very hard. And that's why there can be an optimistic view on settling on a new positive paradigm, or a pessimistic view that maybe it's going to be unsettled for quite some time. In terms of more specifics, I think there's a lot of uncertainty about inflation. I think the optimists think inflation is going to come down quickly, and we're going to return to pre-pandemic low levels. And that is obviously very positive because it means that the world's biggest central bank and other central banks can cut rates a lot. But that's as I just discussed with Mr. Her's question, that's not a clear-cut forecast. Geopolitics, I think, is another big uncertainty, which is much bigger than it used to be. The third one, I think, influencing for economists a bit is actually financial markets. It's a bit of a dance. Financial markets depend on economic forecasts, but economists also depend on financial markets. And, you know, we've seen financial markets rallying again now, and it's leading to economists to think maybe things are maybe not as bad as we thought. And then the final thing I would say is China itself. China is the second largest economy. I think there's a lot of uncertainty beyond the reopening. I talked a bit about it in my presentation. How much pent-up demand will there actually be? And then with the very high debt levels in China, can they afford to keep the stimulus going for a sustainable period? I think the pessimists kind of in the camp that the pent-up demand will not be as big, and China can't afford to do another big debt stimulus cycle because it will be bad for the economy in the longer run. So I don't know if I fully answered your questions, but I think there's a lot of reasons why you can have these different views. And I will just conclude by saying that this really, what I talked about and how you framed it with different investment banks having different views, I think it does mean that we're going to have a lot more volatility this year in financial markets.
Yes, your point on the demand pull inflation and supply shock inflation was well understood. Let me just add one thing about this China reopening, because Korea's export will be greatly affected by this positive effect of Chinese reopening. Although you said there are two opposing views, the rebound would not be so strong as you mentioned, because there is not much excess savings in the Chinese economy. But there is also an opposing view. You said that monetary and fiscal stimulus will be, engaged, and I agree with this the latter views, because the government efforts to boost the economy. I recently observed in Chinese financial authorities action to relax leverage restrictions on Chinese banks' exposure to the real estate sector. I think the previous Vice Premier Liu He's policy stance, I think, is different from the incoming Premier Li Qiang, who now seems to have an opportunity to redress the imbalance and revive the economy through relaxing some of these financial regulations. Do you agree?
Yes, I very much agree. I think
취약층에게는 큰 어려움이 있겠지만요.
I think that is where the policy stimulus is most focused, is on to revive the property market. So I very much agree that there is definitely stimulus coming through to help property developers, but also end demand for homes. They're starting to, I think, encourage banks to provide more support to first-time home borrowers, and also relaxing some of the restrictions. I think there's going to be further easing in the property market in the coming months. Maybe home ownership restrictions in second-tier cities will be relaxed. Maybe down payment restrictions, mortgage down payment restrictions could be relaxed as well. So don't get me wrong. I think, so where do I stand on those two camps? I think there is definitely going to be some pent-up demand coming through unleashed, and it will be also propelled by the policy stimulus. In a way, policy stimulus when the Chinese economy was locked down didn't work very well. It was like the bicycle chain was off the wheel, but now the bicycle chain is back on because the economy is reopening. So the stimulus should be more effective. But I don't think it's going to be as strong pent-up demand as we had in the US. And, you know, maybe that is a good thing, because in the US, we ended up with an inflation problem because of maybe too much pent-up demand. So, you know, maybe it will be good not to have too much pent-up demand.
Okay.
All
Okay.
right, all
Thank you.
set?
Thank
Okay,
you.
thank you
Yeah,
very
yeah.
much. Okay, now it's time to close. But because we had such a exciting presentation and following discussion, I'm obliged to say something about as a quick recap of what we have here. Now, certainly the message from Nomura this morning is that we have strong headwinds this year, at least for the first half of the year. But then we start seeing silver lining down the road. Even if there are some cases where, like in the United States, Europe, Korea, we may see some mild recession. But soft landing is most likely, and global recovery will be helped by relatively robust Asian economies as a whole. Now, as for the negative growth forecasting for a country like Korea, now I think we should appreciate the true value of below consensus forecasting, because at least in two ways. First, the message from such a very cautious approach to forecasting when countries growth is that the policymakers, corporate executives stay vigilant about potential downside risk. So that's a very important message we should get. Another one is that for government and corporate financial institutions, be prepared for preemptive measures to cope with downside risk we may end up having in place. So with that, I think we should be grateful for the excellent presentation and key messages that Dr. 슈바라만 shared with us this morning. I'd like to thank you, Rob, for your brilliant speech and stimulating conversation afterwards on behalf of our members and audience. Thank you very much.
Thank you very much also, Dr. Chun. It was a pleasure to be invited to speak.